TheoTrade. This is Don Kaufman. It's June 1st, 2019, and you are watching the TheoTrade Weekend Update. The month of May is in the books, and I got to tell you, from the looks of things right now, this volatility in this marketplace, well, this is not going to die down, meaning that looks like we're going to have a summer filled with volatility. It doesn't mean just a rough ride necessarily to the downside, but hey, undoubtedly, we are looking at Mr. Toad's wild ride throughout the course of the summer. And as a trader, you know, when a lot of people are like, the summer, it's going to be a little bit of the summer doldrums. You know, you can put away your S&Ps over the summer because they're not going to move. I would strongly disagree with that statement coming into, again, here we are, again, June 1st. And we are on the verge of really kind of a hideous marketplace, which is precisely what we were talking about on last week's video. In fact, I think we even called it the verge of getting ugly. Let me get down to it here. Let's talk a little bit about the S&Ps, kind of where things are on a percentage basis, and really kind of project forward a bit. So as I said, the month of May, we'll kind of zoom into it. Now I'm looking at this specifically in the S&P futures, and here's literally May 1st to, well, the end of May, and it's a precipitous slide inside of the marketplace. You know, when you start to pull this up on a percentage basis, and I like to do that, so I'm just going to pop a year-to-date percentage in here. The slide, well, roughly speaking, we're up about 18% in the spiders on a year-to-date basis entering into May. Now we're up about 10%. Now, the reason I'm bringing that percentages really to the surface over here is simply in respect to the fact that people are going to start talking about a corrective marketplace. Well, in a corrective marketplace, a correction would be in excess of 10%. The Nasdaq is and was up 23.5%. Effectively now is up about 12.3%. So, you know, in my book, we're home. The Nasdaq is in a correction right now. If you remember the not too distant past, in December, the Nasdaq was in full-blown bear market territory. Now, looking on down the list of some of the usual suspects, so I pulled up the spiders. You saw it was down about 8%. The Qs are down just over 10% in the month of May. Then I want to look at some areas that have not necessarily been hit as hard, that very likely to feel the brunt of this. So the financials were up about 17%. They're now up about 8%, but this accelerated dramatically based on some of the action in the bonds. And if you've tuned in to any of the videos, I mean literally any of the videos that we've done recently, we have been discussing the financials literally ad nauseum with the expectation, of these financials literally breaking down. Now, the other aspect I would look at in here, if you take a look at energy, it's also well worth noting energy has been just taken to the woodshed, and this actually kicked off some of the sell side activity. Energy again was up just shy of 18%, is now roughly flat on the year. I mean, you're looking almost at full-blown bear market territory inside of the energy sector, and I just wanted to highlight that because right now you got to think about like strength and weakness in terms of sectors. If I take a look at another one that we brought up just about a week ago, and we actually talked about shorting this, literally showed you how to short this just a little over a week ago. This has been a spectacular position. The only reasoning behind wanting to get short, it's XLP, it's consumer discretionary, is because it hadn't reacted like the rest of the marketplace. Meaning that the XLP hadn't actually taken it on the chin when the rest of the marketplace has been slipping throughout the course of May. And here's obviously May in the XLP. Consumer staples, I should say, has taken a larger hit. You can also throw consumer discretionary in that bucket. Was not sliding as much on a percentage basis and really also accelerated to the downside. So again, we're looking at a lot of different, again, consumer discretionary, consumer staples in the most recent, again, slide at the downside. So of course, what a lot of people are going to ask is, is some of this going to continue? Well, I'm going to come to that here momentarily, but before I do that, I really want to get into the SPX. All right, and some of the expected moves. So the marketplace, let me clean this up for just a second and come back to a standardized numerical form instead of percentages. The marketplace exceeded the expected move this week, and this was the entire discussion, of course, in the Thursday night video. The Thursday night video just simply, propositioned the question was, are we actually going to crack through expected move? And if we crack through this edge of the expected move, things have tendency to get substantially more, well, ugly. And, again, the S&P's closed down almost 40 handles on that one. It was an acceleration outside of the expected move. Now, given the acceleration outside the expected move, and again, just because we break the expected move and, people like throw their hands up and like, whoa, wait, I thought we were supposed to be inside of that. You are, about 68% of the time. But here's one of the big takeaways about these expected moves, and what we've seen substantially in much of the recent years of trade. When you crack through the expected move in the bottom of it, and again, the expected move, for those of you that are a little bit uninitiated, it's how the option market depicts risks moving forward. So, for example, this is next week's expected move. Next week's expected move has right around, a $58 movement. Now, where do you find that? You can cruise over on the thinkorswim platform, actually cruise over and look about a week out. There you go. It's about a $58 expected move. Okay, that's reflected, and I literally drew a line. This is where we're currently at, $58 higher, $58 lower. So the marketplace, again, is supposed to stay inside of this range. Doesn't mean it can't crack through. It means by the end of the week, we're supposed to be inside the range, and that's supposed to occur about 68% of the time. But as I was saying a moment ago, one of the things that we're seeing extensively in recent years is when we break through the expected move, it's not mild. We're shattering through it, and it has everything to do with hedging activity. So as I explained on Thursday evening, the higher probability was to stay inside the expected move. But as I kind of mentioned, if we're going to crack through it, things just get hideous because hedging activity will actually drive us far away. This doesn't look like much, but a breach, of expected moves. Only 4 trading days in this week. The breach of the expected move, and we weren't looking at like a monstrosity of a move this past week, right? Look, you can see the start point was somewhere around 28.30. The upper end of this, was like 28.70 and change. So what are you really looking for? 40 some odd point move? Well, we move $40. We move $40 just on what? On Friday alone. So again, we hit almost that 2 deviation kind of move territory. Now the expected move jumps from the mid 40s, and now the expected move, as I said a moment ago, widens out to $58. So that's why when I was mentioning as we kind of kicked this video off today, I was mentioning a summer filled with volatility. Why do you think I'm mentioning that? I mean, listen, the marketplace is depicting that we're likely to move a heck of a lot more than we did quite recently. So again, the SPX is starting to pick up a little bit of volatility. But I'm going to cover volatility again here in just a minute. So hold that thought, because you've seen the S&Ps now, and I'll again allude to this. You've seen the S&Ps come off from all-time highs, 2950. We've dropped already now to 2750. Okay, now again, just kind of foreshadowing here. Who would have thought with a 200-point drop in the S&Ps that we would be sitting below a 20 VIX? Throw that out there for your entertainment. Next thing I want to look at is we're going to jump back to the S&P futures. And the reason we're going to jump back to the S&P futures, we're going to talk just a little bit about gravity points. Here's our gravity points: 2911, 2842, 2811, 2731. Right now, we're a hair off 2731. Do we have to check that box to the downside? Absolutely not. Nevertheless, be mindful of these gravity points. We break through 2731. It's a straight shot down, 2682. One of the things that I've been discussing extensively, and I cannot stress this enough, and I'm actually going to close up this left side bar. In all of the recent trade that we've seen, that we've actually traded, again, I'm going to draw a line right there. That is 2811. Right down here, that's 2731. All of the trade that we've seen occur, in this territory, when I say in this territory, between 2811 and 2731, all of that trade has been wicked volatility, right? The only time that we actually meandered was meandering back to the upside in here. Everything else that's actually occurred, in this, all right, we call this just like the volatility entryway. It is wicked. I mean, look how fast some of these moves happen to be, all right? 1-2 days to the upside, 1-2 days down, and we're not talking about a small range. Again, we're talking about 2730-ish to 2811. You just put that in a little bit of perspective there. Look, we're looking at what, 70, 80 point moves inside of the S&Ps, And it's occurring, again, every time we get into this channel. It's wicked, and you need to be mindful of that. That's why I said we ragged through 2731, straight shot down to 2682. Look at some of the recent trade. All right, what you have to understand is we're now, officially, we're in this volatility box that we were back in October. It doesn't mean the market's going to act per se like we were in October. We know one thing, okay? We know that risk just simply gets wild, okay, in this zone. And we're in it. And I was talking about this again extensively the last couple of weeks. Are we about to drop back into that volatility kind of channel where you can expect, again, some extraordinary moves and pinging literally back and forth from gravity point to gravity point? All right, enough said on the gravity points. The next thing I want to point out, you have a high degree of correlation that's really gripped hold. Now, I'm not going to go too much into this, but a high degree of correlation, what it effectively means is I have tendency to look at the S&P 100. I look at the S&P 100 because the other 400 stocks in the S&P 500 simply don't matter. It's all about 100 stocks. I mean, you guys have to realize now, there's like 20 stocks that drive, okay, a huge amount of the S&P 500 in terms of a percentage basis, how much market cap they have. I mean, it's the usual suspects, right? It's your Microsoft, it's your Apple, it's your Facebook, it's your Amazon, it's your Google, all right? That's what drives it. And then the financials are right behind that, and JP Morgan. We're talking huge market cap out there. When we're correlated, though, like this, the S&Ps matter more than individual stocks. Effectively, when the S&Ps move, so goes the entire market. So look for higher degrees of correlation as we're starting to hit bouts of volatility. Now, the reason that this matters is that if you're looking for opportunities, start to look sector to sector. Like a moment ago, I was showing the energy sector is getting killed. If the market's going to rebound, energies going to be, you might want to be in energy if the marketplace is going to rebound. Expect rebounds, expect bounces. It's not a one-way ticket to the downside here, people. I mean, even if you're bearish like I am, it's not a one-way ticket to the downside. Be aware of that. Correlations really grip hold on down days, but when the market's heavily correlated, worry less about individual stocks and more about sectors, okay, and the S&Ps as a whole. Next up on the docket, let's actually cruise over to the spiders. In this case, I want to talk briefly about what I term shorting into the hole. What shorting into the hole effectively means is, listen, you've seen the marketplace, what? It's got some slippage right now, all right? Slippage means, all right, we're heading down. You can't get short over here. You can't get short over here. Now, you might be able to find a sector or an individual underlying that hasn't necessarily participated. I'm all about that, right? Like I'm all about like, okay, I was mentioning the other night, Walmart hasn't participated to the downside, or we're looking at the consumer staples that had not participated to the downside. Shop around a little bit, okay? There's some stuff that's just brutally oversold in the near term over here. If you want to get bullish, okay, great. But you can't get bearish in the S&Ps after they've sold off 10%, okay? I mean, when can you get bearish? When when you see some wicked bounce back to the upside, when it takes us all the way back up, to like 28, 284, as I was going to say inside of the SPX, 2840. But again, when you get the wicked bounces is when maybe you can short. Right now, you don't want to short into the hole. And that's going to be true really of any products out there. I stress this because people have tendency to want to kind of hop on the bandwagon from a logic and a strategy standpoint. Okay, listen, this chicken is already cooked. All right, that chicken is done, it's cooked. Let it bounce, let something occur, or look for another product that hasn't actually fallen. If your assumption right now is that this S&P is going to continue to fall, okay, then you need to find other products, okay, that haven't necessarily fallen on a percentage basis. Need I bring up Microsoft? Microsoft, if you want to take a quick glance at it, and this is a pretty good explanation in here, Microsoft has fallen, okay, but really, all right, net versus what the Nasdaq has done, Microsoft is trailing on a percentage basis the fall inside of the broader marketplace. So what do you expect? If the S&Ps and the Nasdaq continue to fall, Microsoft gets absolutely hammered. Hey, next stop, it's down in the neighborhood of, here, I would say down in the neighborhood right here of like 120 again. Even the 115 marker could absolutely happen. That's kind of what I'm talking about without shorting in the hole. There's better opportunities than trying to short a marketplace that's already effectively down. Speaking of shorting, let's talk about the bonds. The bonds have gone absolutely, unquestionably parabolic. They scare me, okay? What scares me? I've said that a lot lately about the bonds. What really scares me about the bonds? This parabolic move to the upside, okay? It's also one of the most heavily shorted positions right now in the entire industry. Listen, Everybody right now wants a chunk of this. It's too crowded of a trade. Will I short bonds? Yeah, I will actually jump in and short bonds. Okay, and I was talking about this a bit in recent weeks and talking about it in the TheoTrade chat room. I will short bonds, but just based on some of the movement we're seeing to the upside, now I got to wait. Even at fear of missing out on the short bond trade, I have to wait. These things, they've already gone parabolic. Okay, they can explode even further at this point in time. The short bond trade, unequivocally speaking, it is not there for me. I am not going to short bonds at this point. By the way, this chart doesn't even do it justice because there was a contract. This dashed line is a contract roll. You really want to do it justice? Go over to the TLT. Okay, does that look like a bond product? It's insane. Even the volume is flying in this. It has all the signs of a product, right? That's so overbought that you know it's going to come back in. But the problem, as I said, it's too crowded. Everybody wants to be short. When everybody wants to be short, the further we go up, the more we spur it up. Why? Because people got to cover the shorts. How do you cover shorts? By buying it in. Anyway, the financials, and I'm going to tell you why they make me nervous. Not because I want to short them, because when the financials do, okay, or I should say the bonds, okay, when the bonds take off to the upside, obviously they're going to put the pain, if you will, into the financials, okay. But the issue that I now currently have is I'm short in the financials. I'm not necessarily short in the bonds, but I'm nervous because I'm scared that the bonds, when they do come down, it could actually provide fuel, okay, for those financials to explode higher. Again, I don't see any of this coming to fruition right here, right now. Frankly, I think that the bond trade, as I said a moment ago, has some more room to the upside. And if you heard me a second ago, I'm talking about bonds and I'm talking about financials. They're interchangeable, okay? But at the same time, it's the products themselves are just joined, absolutely joined at the hip. As these bonds head higher, okay, the financials, they just get pummeled. And yet, when I look at the financials right now, I don't see as much quote unquote pummeling as I think I should. And it bothers me as a trader. And I said, you know, when I kicked off and I started looking at the bond trade, I said, oh, the bonds make me nervous. But it's not really about the bonds. Yes, the bonds make me nervous, like if I was going to try to short them right here. It's not about the bonds, okay? It's about the fact that I'm short the financials. And the bond trade has gone just insanely parabolic. And by the way, this also relates, of course, to the interest rate, right, to the TNX. All right, this thing, it's just fallen completely out of bed. You know, just when you thought interest rates were low, right? I mean, what does this say about the economy? What does this say about, you know, what the Fed is about to do? Clearly, low interest rates are kind of in play. You know, where's a stopping ground? 2%? And I was almost joking about this just over a week ago. I said, you know, a stopping ground might be 2% on the 10-year. Okay, we're almost there. I mean, literally, you know what? You know, we're almost there. This is, you know, 2.1% is what we're now facing as those rates go lower. That can really impact, again, the financials. But you just don't see the financials as parabolic, if you will, to the downside. And that's that nervousness. That's that, you know, why I'm actually looking at this. Now, that is, to me, completely perplexing. But with being perplexed by the financials to a degree, the one that really has me is if you're looking at volatility right now, click this just to a 9-month. If you're looking at volatility right now, you're left wanting more. The volatility in early May took off to the upside, reverted back, is now on a bounce, okay? But the volatility, first of all, the VIX is at like 18. It's pretty lackluster. The one aspect you have to realize is, okay, the risks in the marketplace. Hey, listen, the Nasdaq's off 10%, right? The S&Ps are facing corrective territory. Looking at the VIX, you'd think this stuff was a walk in the park. The VIX needs to take off. Like, there's no capitulation type trade. Here's where, you know, when people want to talk about getting bullish or bearish in the marketplace, here's where hopefully I give you a little input, little feeling to this. This volatility needs to explode. Or I'm going to tell you exactly what's going to play out. If the volatility takes off to the upside, I mean really takes off to the upside, the S&Ps would be getting hit and hit hard. But if the volatility explodes, we can have a degree of capitulation. Then the S&Ps can bounce and they continue along their merry way, right? The volatility would come down, the S&Ps could bounce, and they continue on, as I said, along their merry way to the upside. This is not what you want to see in the volatility. The volatility is lackluster. The volatility is just creeping up. I mean, look at this. Okay, look at this. The VIX is up what? A point, with the S&P's down. Okay, what? 1.3%. It's negligible. We're up like 8%. It's not feeling the volatility bump, which tells me the capitulation in the marketplace is just nowhere to be found. Okay, nobody's feeling the fear. They're not going to feel the fear until the volatility spikes, which effectively means I'm not telling you the market's going down. Okay, I am telling you if the market goes down, though, we've got a long way here. Right, the door could swing wide open because the volatility hasn't actually bounced, hasn't started to rip into the upside. If you don't believe the VIX, I'm fine with you. I don't necessarily believe the VIX either. So I look at the VVIX, it's the volatility of the volatility index. And you realize the volatility index isn't even sitting at 100. Okay, that's professionals. They're just shrugging their shoulders like, you ain't seen nothing. This is nothing. I've seen this risk before, right? I mean, come on. Here's the beginning of May. You back up over here. Again, we're in nothing kind of territory with the VVIX below 100. You're like, okay, I don't really know the VVIX. All right, yeah, let's go look at the volatility futures. You know what the volatility futures are doing? They're laughing at us, I tell you, absolutely laughing at us. The volatility futures, right, haven't even inverted. Again, this is another sign that risk is just like lackluster. Look at the June volatility future. That's with 18 days. The June contract sitting at 1820. Jump out here to the July contract. It's 1840. What do you got? You got nothing, people. We're not even inverted. We don't even have a flat vol skew. The vol skew kind of still looks like this, right? So here's your 1820. Come out a little further. It's 1840. All right. It's to me, little chaos given the fact that we've seen some sell side activity. Again, it flattens out a little bit longer in the curve, but we're not in that state where we say like markets are crazy because the June contract hasn't exceeded, all right, the July contract. So all of these elements there are really weighing on me kind of heavily. And again, when I look at this, everything right now points to a summer filled with volatility. Now, I don't want your takeaway to be from this that, you know, the market's a place that's going to tank and so forth. All right, here's the bottom line of what I would look at in a marketplace. First of all, in the very near term, look at that sell side activity. It's been hideous. Okay, it's been hideous. And at some point, yeah, we're going to have wicked bounce. Okay, you got to look for the bounces. The bounces at this point in time, probably going to want to short into them. Okay, the way I'm looking at this, and I have been looking at this for a long time, all right, given where volatility happens to be, where the bonds are, the door is wide open in the marketplace. Okay, a bounce could be very, very short-lived, but the door is wide open to the downside in the marketplace. Listen, you've heard the risks that are out there. Tune out all the media, tune out the Twitter feeds and so forth. It's just too much to try to even interpret. The Twitter feeds, they were going off like crazy throughout the course of this past week. You know, the Mexico tariffs, need even mention them. Everything's already priced in, right? And it's priced in this case. But again, we have the door, what I would term, swung wide open. The downside is there. It's there for the taking, meaning that the bonds are already indicating the market bottom could fall completely out over here. Look at oil. I mean, come on. Oil. It's getting killed. Oh, yeah, that's not a global demand issue over here. I can give you a million different bearish cases. And you got the financials, which have actually held up relatively well with the bonds exploding higher. Then volatility is shrugging its shoulders. Okay, we have to get downright ugly. We have to get mean before you're actually going to see this volatility start to spike. You have to look at this marketplace from sheer risk reward right now. The downside is huge. The upside potential is limited. Keep it in mind moving forward. Again, we're entering into what looks like it's going to be a downright volatility-packed summer. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.